Okay, let's get right into it. Welcome to The Explainer. Today, we're putting FTAI Aviation through a relentless, data-backed investigative audit. We're going to cut straight through the hype of its recent stock price, which, by the way, has effectively doubled over the last 12 months, and we're digging deep into their 10K, their 10Q, and historical financial data. As an investigative journalist of financial statements, I'm here to leave the flashy narratives at the door and let the cold, hard numbers do the talking.
Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Look, the market is in a state of absolute euphoria right now. FTAI's stock price has rocketed up over 100% in a single year, sitting at roughly $203. But there is a stark underlying reality here that we need to talk about: massive cash burn. We're looking at a negative $338.5 million in free cash flow, which is a massive 71.7% drop year over year. The market is out there cheering for top-line revenue, but behind the scenes, the cash register is literally flowing backward. To understand how a company can sell 41% more but actually earn 28% less in a single quarter, we really have to look past the headlines.
Section 1. Media Blackout. 14 Hidden Flags. All right, let's rapid fire through 7 glaring red flags buried deep in the filings. First, the media completely ignores the negative $338.5 million in free cash flow because, well, it ruins their simple earnings growth narrative. Second, they skip right over the massive 10.32 debt-to-equity ratio, mostly because it's just too granular for a catchy TV soundbite. Third, there's a 77% collapse in their legacy leasing and power segment, but that easily gets masked by their shiny new aerospace division. Fourth, poor earnings quality, where 62 cents of actual cash used for every dollar of reported earnings, but complex accounting accruals just aren't sexy enough for the news. Fifth, we've got a looming $3.4 billion in total debt leverage, completely ignored as long as the stock keeps going up. Sixth, a negative $310.7 million in operating cash flow, again, easily hidden behind paper profits. And finally, a dropping gross margin, down to 46.2%, which is brushed off by analysts who are purely focused on volume.
Now, to stay totally objective here, we have to look at the green flags that are keeping the bull thesis alive. Number 1, aerospace EBITDA is up 51%, acting as this booming engine that masks the legacy decay. 2, it's literally impossible to ignore their 44.5% full-year revenue growth, hitting $2.5 billion. 3, investors absolutely love cash returns, so the 41.67% growth in the dividend payout is a huge draw. 4, they boast a highly impressive 20% net margin. 5, an astronomical 149.9% return on equity. 6, a remarkably safe 5.28 current ratio, showing really strong short-term liquidity. And 7, you top all of that off with a massive $364 average analyst target price, projecting nearly 79% upside. So the really crucial question here is, how do we weigh these entirely contradicting flags?
Section 2. The ultimate valuation gauntlet: cash and dividend models.
Okay, let's look at Group A, our cash flow models. Whether we're looking at a standard discounted cash flow or an adjusted present value, notice a really glaring trend. These intrinsic values all cluster dismally low, between $80 and $125. You might be wondering, why is this so far below that $203 price tag? Well, it's because these models mercilessly penalize the company for its negative $338.5 million free cash flow. When actual cash isn't entering the business, these cash-based valuations simply collapse. But then, contrast that with Group B, the dividend and income models. Suddenly, the standard dividend discount model spikes to $250, while the multi-stage model hits $195. Why the massive jump in these specific valuations? Because management recently hiked the dividend by nearly 42% to a $2 annual payout. This artificial injection of cash back to shareholders dramatically props up income-based valuation models, even if the underlying operating cash doesn't organically support it. Let's shift away from cash generation entirely for a second and look at market multiples and the actual assets on the balance sheet.
Section 3. Ultimate Valuation Gauntlet, Part 2. Comparables, Balance Sheet, and Advanced Models.
Shifting to Group C, the market comparables paint a wildly divergent picture.
Traditional metrics like price to book crash all the way down to $90. But look at the enterprise value multiples. EV to EBITDA and EV to sales literally shoot up to $230 and $240. Why? Because these specific metrics eagerly credit FTAI for its $2.5 billion in top-line revenue growth, while completely, and I mean completely, ignoring the heavy drag of that $3.4 billion in debt just sitting on the balance sheet.
Wrapping up the gauntlet with groups D and E, pure asset plays, we see the absolute extremes. If the company had a fire sale liquidation tomorrow, it's worth a grim $30 a share. However, if we run a real options valuation using advanced Black-Scholes logic to value their explosive aerospace expansion as a future growth option, we get the most optimistic number on the board, $280.
Think about this for a second. We literally just slammed this company's financial data through exactly 21 distinct valuation models. This isn't guesswork. This is an exhaustive, hype-free audit of where the numbers actually point when you completely strip away the market sentiment. So what would the masters of capital allocation think of these numbers? Let's find out.
Section 4. Legendary Investors Reality Check. Filtering FTAI through the greats. First up is Ben Graham, the absolute father of deep value investing. His proprietary number demands a strong balance sheet and a low multiple. For FTAI, it is a hard fail. The $3.4 billion in debt, which results in a crazy debt-to-equity ratio of 10.32, combined with a forward PE of 22.3, well over his strict limit of 15, completely destroys any margin of safety. Ben Graham simply wouldn't touch this. Next up, Peter Lynch. His verdict? Mixed. Now, Lynch loves growth at a reasonable price, and he might actually initially like the PEG ratio, driven by that staggering 44.5% revenue growth and the new dividend yield. But Lynch also strictly preached the understandable business test. The totally bifurcated nature of FTAI, a skyrocketing aerospace module business, internally warring with a 77% collapsing legacy leasing business, makes this far too complex and contradictory for a classic Lynch play. Finally, we have Warren Buffett. His ultimate test is owner's earnings, which is the actual cash an owner can pull out of a business after maintenance costs. Despite an incredible 149.9% return on invested capital, this is a fail. Why? Because the negative $310.7 million in operating cash flow completely kills the test. Buffett would pass on this stock instantly because the high net income is really just an accounting creation. It isn't actually backed by owners' cash in the bank.
Section 5. Moat and synthesis. The final verdict.
Let's wrap this all up into 3 clear conclusions based strictly on the filings. First, based on the straight mathematical average of all 21 distinct valuation models we just ran, FTAI Aviation is unequivocally overvalued compared to its current $203.43 market price. The market is pricing in a flawless execution of the aerospace expansion while entirely, and I mean entirely, ignoring the cash burn and the balance sheet debt. Second, let's analyze their economic moat across Morningstar's 5 sources: intangibles, switching costs, network effect, cost advantage, and efficient scale. While FTAI's aerospace division is definitely expanding its switching costs because airlines simply don't easily change engine maintenance providers once they're locked in, the overall company moat remains remarkably narrow. This is heavily due to the capital-intensive, highly leveraged nature of their decaying legacy leasing fleet dragging them down. So, here is the bottom line you need to walk away with. The stock price tells a story of euphoric growth, but the cash flow statement tells a completely different story of a business operating on financial leverage and accounting accruals. The models are pointing one way, but hidden flags suggest a storm. Which side are you on? Do your own homework.